Good afternoon, everyone. This is Mark Robertson with the 506 Investor Group. Today we have yet another webinar with the sponsor. Proud to introduce Jeff Baker and Morgan Smith with the Sortis Income Fund. Welcome, guys.
Hey, thank you, Mark.
Very good. Well, we'll just let you kind of go through your presentation. It probably won't be as long as a normal one since we've already seen one of your webinars, and then we'll jump into the questions that have been submitted. And the members online can type in questions to the chat bar, and we'll ask those as well.
Sounds good. Sounds good. Well, hello, 506 members. Many of you may have seen a webinar I put together, and it was based on some slides that are in this, one of which is up and on your screen. And I'm just going to cover a few things out of our deck, just to give you a highlight of our fund, knowing that many of you have seen a lot of information about us. And then we'll jump into some Q&A so we can get into the meat of the conversation. So let me introduce myself. I'll let my partner Morgan introduce himself. Then we'll talk a little bit about the Sortis Income Fund and some highlights. And then we'll jump into your questions and try and get everything addressed. So my name is Jeff Baker. I'm a fund officer of the Sortis Income Fund. My background, I came up as a CPA in the Northwest in the Portland, Oregon area. I joined a bank called M-Bank in 2005 as their CFO. We got into the financial crisis in 2007 and 8, and somewhere along the line, I found myself as the CEO of that bank. It wasn't necessarily because I was a great young executive, but I think no one in their right mind wanted that job, given the economy, the condition of the bank, and its likely outcome. But we were able to work through a lot of troubled assets, a lot of loans, a lot of foreclosures, a lot of half-finished projects, and we were able to get that bank back on good footing. We brought in some new investor dollars, and we ultimately sold that bank about 2.5 years ago to a larger regional community bank. And what that did, that allowed us to start the Sortis family of companies, and our bank holding company stayed in existence, but instead of running a bank, we decided to migrate into private finance. And so moving out of the banking industry, we had a pretty good understanding of where the demand and the need was for private financing out there, and we were able to launch into that. So I sit today working at Sortis Holdings, a former bank holding company, and I act as a fund officer for the Sortis Income Fund. Let my partner Morgan talk a little bit about his background and who he is, and the guy that really puts the money to work to generate the income for the fund.
Thanks, Jeff. Thanks for the opportunity to speak with you guys. My name's Morgan Smith. I had lending for Sortis Financial and the Sortis related entities, which means I spend a majority of my time placing the dollars that we have under management in the Sortis Income Fund. My background, I've been in the mortgage business basically my entire adult career. I started a mortgage company in 1995 by the name of Morgan Financial. I was fortunate to grow it to about $1.5 billion company in origination, and then was even more fortunate to sell it in March of 2006 to a hedge fund. As I exited that phase of the business, kind of right when the financial crisis started, I became interested in buying distressed assets and managing distressed assets, which led me into non-performing loan servicing and the purchasing of distressed loans. And ultimately that led me to partner with Jeff and the guys at Sortis. I had been trying to purchase a non-performing servicing platform, and they had actually beat me to it, and so we decided to partner on it, and that's kind of how we began our relationship. I also held a post briefly at M-Bank, managing that servicing division, and at the same time started up the private lender. When we went to the liquidity event at the bank, the holding company, which is now Sortis Holdings, actually bought my private lender and brought it into the platform. So that's how I fit into all of this. Again, I spend my day-to-day managing a staff here in Portland, Oregon. All of our lending's done in Portland, Oregon. Our servicing and debt collection activities are handled through Dallas, Texas. So we've got underwriters and doc people and account managers sitting in Portland, managing the process of private lending. About 25% of our deal flow comes from what I would call retail business, which is folks that we know directly, builders, investors, different people that, clients I've built over the years and friends of Sortis. And then about 75% of the volume that we place in the Sortis Income Fund comes from other mortgage professionals. So we work with several large non-bank mortgage origination platforms, companies that you would probably have heard of in your part of the world that are primarily out doing agency, FHA, government types of mortgages, but they have enough of a sales force that they're running into from time to time private mortgage opportunities, primarily in the fix and flip, ground up construction and bridge loan space. And so we positioned ourselves to be a partner, a business partner with those types of originators. And that's where we get a majority of our deal flow. So look forward to working with all of you, hopefully. And, I'm just here to kind of answer the nuts and bolts questions of how the lender works, how our underwriting decisions are made, how we manage our process. We're a very transparent group. We would welcome any of you to come to our office if you ever had the desire or you're ever in Portland and kind of see how we operate. But we're a pretty simple business. We're just, making investment decisions based on our underwriting criteria to fund private loans.
Okay, well, let's see. So once again, many of you have seen some information about the Sortis Income Fund, but let me just give you a real high-level review of the fund itself, just so and then we can get into kind of the question and answer. So I think I mentioned briefly, we sold our bank and we got into the private lending space. And really, there's a gap there where us hard money lenders fill a niche. Banks like to make long-term, fully amortizing principal and interest loans. They like the underlying collateral to produce cash flow. So they're just not a great partner to lend to a fix and flip. They tend to shy away from construction. And even a short-term hold on a bridge loan is just not something that is in their wheelhouse. And so that's where we step up and we provide financing to people, and we're able to drive a pretty high interest rate and points on loans. And we offer a very short-term product, generally a 12-month interest-only loan that much better fits with the game plan of our borrowers. I'm going to let Morgan talk in a minute about our underwriting process. I think that's important to talk about a little bit. Our management team, you've heard from myself and Morgan. I come from a banking background. He comes from a mortgage and hard money lending background, and Morgan's certainly been in financial institutions building lending platforms. So we've lived and breathed lending for most of our working lives. The Sortis Income Fund, it is a fund that holds loans. So we're not a real estate owning entity. We strictly source, originate, and underwrite all of the loans in the fund. We have an array of loan types. We have bridge lending. We do a little fix and flip, fix and hold. We do some construction lending. The fund's set up to take a $25,000 minimum investment from accredited investors, so a Reg D private placement. We're set up as an LLC, and our investors get K1s. We have a pretty generous redemption liquidity policy. We ask folks to stick with us for 6 months, and then once that time comes, you're available to put in a liquidity request. Technically, our docs allow us to pay that out at quarter end, and it's based on the order the liquidity requests were received. And we can delay that to the extent that we don't have adequate maturities or prepayments on loans to pay that. But I'll tell you from our experience, we've been able to pay out within a week any liquidity requests that we've received. But I'll be honest with you, when we've been returning 11% plus returns to our investors for the last 2.5 years, not very many people have asked to leave. And so we haven't really put that to a significant test. But in general, we work hard with our investors who we consider our partners to take care of their liquidity needs as quickly as possible. Our fund, we have target loan yields of 12 to 14%, and add a couple of points on there, turn the money 1.5 times a year. We're trying to achieve gross returns of 15-ish%. And then after our fees and some expenses, that's allowed us to return to our investors a little over 11% since inception. Our holding company and its wholly owned subsidiary, Sortis Financial Inc., which is a licensed lender, loan servicer, and debt collector, are the managers of the fund, and then Morgan and I serve as fund officers. And then just for what it's worth, we've been put up on the Fidelity platform through National Financial Services. So we have some investors that have Fidelity accounts, and also that we work with some RAs out there who use Fidelity as a platform. Maybe I'd
so I can chime in a little bit.
Yeah, Morgan, you might cover this info, and then
well, I was gonna say, like, yeah, that's good lead in. Maybe back it up just a second. Raising the bar a little bit. You know, philosophically, I thought I'd just kind of touch on why this type of lending is working. You know, following the financial crisis, obviously there's been tight liquidity as it relates, especially to community banks and different types of financing institutions. So a majority of our borrowers, the types of people that we serve, used to get their financing from companies like the bank we used to own, and that community bank, small to mid-sized bank, was kind of the institution that satisfied that type of leverage, whether that be spec construction lending or smaller guys in terms of renovation. And when the financial crisis hit, that basically went away. So this is a relatively new, hard money lending is one of the oldest businesses in the world. They say the second oldest business in the world, to be specific. But as it relates to renovation and fix and flip and what you're seeing today, that's a relatively new business opportunity that's emerged following, you know, the financial crisis, and it's been, you know, made available to fill a need of the small to mid-sized investor who's really unavailable, not able to get institutional financing. So you know, people ask, like, well, how can you get yields so high and different things? And so I try to put it into this perspective for my investors. Our borrowers or our clients are our partners. We are absolutely invested in their long-term success. So we want nothing more than for them to be very successful on their projects so that they can come back and use us over and over again. And many of our customers are repeat customers. Those are the best type. So I say it's a partnership because, you know, in a regular equity type of situation, you know, if you were going out to look to purchase a property and you ask somebody to put up all the capital, it would be pretty reasonable for that investor or that person to ask you for maybe half of the return. Right? I put up all the money and I want half the return. So in our case, you know, we try to put up 65, 70% of the money and make 12 to 14%. So the financial outcome for our partner or our borrower is always going to be better in a situation in which they use us and utilize leverage. And that's really how we look at things. We're not a predatory fund. We don't loan to own. We're not in the business of trying to loan people money so that we can take their assets. We do underwrite our loans specifically so as to, if they do not perform and we take the assets, that we will be covered. And in fact, probably would have a higher rate of return than we would if the assets just paid as agreed. But I want to differentiate that point, because really what we're trying to do is work alongside our partners, our lending partners and borrowers, and help them be successful. let's see. In terms of
Morgan, we probably have just a couple minutes before they want to jump into a Q&A. Did you want to touch on just our underwriting process? I think that's a real of interest to people in terms of how we go about doing loans.
Certainly. So, I mean, I guess I would start with our number one stated goal at the fund is to not lose principal, and we take that goal very seriously. So, at the beginning of every underwrite sits that that thought of we're only going to place capital in loans that we know that we can get our capital back in, and that basically comes down to collateral. So the single most important thing that we do when we underwrite a transaction is to establish value and liquidity of the underlying collateral. We of course then focus on the borrower and the borrower's expertise, in particular his experience and his ability to take a project from beginning to end, and if he has a track record to do so. And then we do of course analyze credit and character and those types of attributes. But we start with collateral, and we focus on whether or not that asset has the ability to withstand a default. We evaluate collateral with third-party reporting. So we order appraisals on every single transaction that we close at the income fund. Our appraisals will provide an as-is value and an after-repaired value, and we use both of those values when we underwrite loans. We use a couple variable, a couple ratios that we focus primarily on in the underwriting guideline, which is loan to cost and loan to value. And so we're going to always base our decisions on a factor of loan to cost and loan to value. And we always use basically the lesser of those two. So for instance, on a construction loan, we're comfortable loaning up to 80% of loan to cost, which would be the purchase price plus the improvements. Add those together, that would be the total cost. We will loan up to 80% on that, provided that the as-is loan does not exceed 65% of the current value, and the as-is loan does not exceed 70% of the after repaired value. So the point I'm trying to make is that we get into a collateral position around 65%, and then we stay in that collateral position from 65 to 70% throughout the duration of the loan, because we draw our renovation payments out through a draw process. So we never allow the borrower to get ahead of us in terms of the amount of money that they pulled in relationship to the value of the collateral. I was just going to add on to that. We also, of course, utilize title insurance, closing services, and all of the loans that we do, we purchase full title insurance policies. We only originate first position liens. We do occasionally take additional collateral in terms of putting a second position lien in addition to a first position lien on other assets, but we're always going to be looking at first position liens. Quick overview on our portfolio, which kind of goes to my point about the underwriting guidelines. We're about 65% as our average loan to value. It's made up about half between bridge lending, and then the other half is spread between what I would call rehab or construction lending. As you know, we're based in the Northwest, so we have a pretty significant percentage of our loans are going to be in Oregon and Washington. We like the coastal states, but we will loan strategically throughout the country, provided that the deals make sense. But for the most part, we're going to be located on the West Coast, a little bit of Colorado, a little bit of Arizona, a little bit of Texas. And as you can see from the webinar, that's our current portfolio breakdown as of the end of January.
Well, Mark, what do you think? Should we migrate and make sure? I know there was some questions submitted we needed to address, and there may be some more coming in.
Yeah, I just wanted to ask a question in general. I've personally invested with a patch of land and fund that flip for 3 or 4 years. And I personally stopped a couple of years ago. The interest rates have come down. I guess it's because of competition's moved in. And on their case, their underwriting kind of went south. And luckily I never lost money, but if you read our old threads, there's been a lot of blood on the streets with a patch of land and their poor underwriting. What do you see as far as the market and the competition for these loans, and is it driving down interest rates, and is there any risk of trying to fulfill the portfolio and the funds by going after riskier loans just to keep the momentum going?
It's an excellent question. So you're spot on with your analysis, basically your macro analysis of the market. Like most good things in lending, eventually Wall Street will screw them up, as we've seen in almost every case in the past. And the fix and flip and the bridge lending market will probably be no exception to that. So within the last 24 months, there's been a lot of institutional capital that's tried to enter this market and has ratcheted up the leverage and basically cranked down the yield. So you are correct that there are lenders in this marketplace, patch of land being one of them, lending home being another. There's several others I could mention that are doing up to 100% loan to cost, 80% loan to value types of renovation lending at rates that are in the mid to high single digits. So it exists, it's happening. We made a conscious decision about a year and a half not to follow that trend. So we don't do the amount of volume that those particular groups do. We've just kind of focused on serving our niche, dealing with our current existing client base and working the clients that we're getting from our institutional partners in the mortgage lending space. We have seen yields trickle down, from, I would say, mid to high 12s to high single digit to low double digits. The way we have combated that in the fund, or the way that we've dealt with that, if we're going to make a loan that has a yield, and when I say yield, it would be the interest rate plus the points. If we're going to make a loan that has a yield of, say, less than 12%, we're only making that loan with the intent that we're going to sell it. And in that particular case, that's a very profitable loan for the fund, because if we were to make a loan at, say, 10% and 2 points, we can turn around and sell that loan to an institutional partner within 15 to 20 days. We've made the 2 points, that yield goes into the fund. We can sell that loan typically at an 8.5 to a 9% coupon, which means we actually get to drag along a point of performance as that loan matures, and we've gotten all of our capital back. So your question is spot on. We have chosen, again, not to chase that and not hold those types of loans, but we are, at times, if they're competitive situations with what we believe high quality loans, we will make those loans, hold those for 15 to 20 days and sell them. I also think it's just a sheer function of our size, to be honest. At $25 million with our deal flow, we've been fortunate enough to have about 3 times the amount of volume than we do capital. So we've been afforded, the privilege of selling loans. Ask me that question when I've got $75 to $100 million under management, I might be giving you a different answer.
Yep.
But that's where we're at today.
And what's keeping your borrowers, your niche borrowers, from reaching out to the patch of lands, lending homes, and getting better rates? Do they not know about them? How can you maintain these higher rates?
Another good question. It's a pretty prolific market, and those guys operate primarily. Patch of land is an example. Lending home, they operate primarily in the retail channel through, they're driving solicitation based on Google ads and direct marketing and advertising on HDTV. Ours are a little more organic. Ours are typically coming directly from salespeople or from ourselves. That's, I believe, part of it. They're also kind of going out and trying to deal with what I would call the super flippers, or the guys that are doing 15, 20, 30 rehabs a year. I would say we're dealing more with the closet industry of 3 to 5 transactions a year, so probably slightly different borrower type. But I think primarily it's just that we're a little closer to the ground. a little more in touch with our clients, and frankly, just not as big, not trying to get our volume from those types of mass channels.
And how many fix and flippers have you had to foreclose on?
I've never foreclosed on a fix and flipper. I had one loan in 2017 that went delinquent, and I sold it. I think the guy eventually paid off.
Sold it at a loss?
No, I sold it at a premium, actually. We've never lost principal in this fund.
On any underlying asset?
Not any underlying asset.
Wow.
We have 3 loans that are currently in the foreclosure process. None of them are fix and flip loans. They were bridge loans from a while ago. They're very low loan to value. I anticipate them actually to probably be windfalls in the event that we get through foreclosure. I doubt that we will get through foreclosure because there's so much equity. But those were kind of an isolated situation. A borrower, 2 loans with one borrower who kind of went sideways. But I feel pretty confident about recapturing that. I have never had to foreclose on a fix and flip or a construction loan though to date. I anticipate that could happen.
What percentage of the portfolio has these potential foreclosed bridge loans in it?
There's 3 loans out of the total population of loans, which I believe is about 45 assets today.
But are the average size? I mean, is it 2%, 4% as far as volume?
I would say, I'm just doing an analysis in my head. It's about $400,000 out of 25 million. Oh, $500,000 out of 25 million. 470. Pretty small.
That's 1% or so. And you've pretty much gone over the question. Oh, the foreclosures. Oh, when you sell the loans, how do you make the determination to sell it versus keep it in the portfolio?
It's a function of yield. So if it wasn't already clear, I'll give you a really quick analysis of how we, how the economics of our fund work. We take all of the economics of the loan transaction and stick them in the fund. So all points, all fees, all of that income flows directly into the fund. We don't pull fees off or pull points off as the originator. We just flow all of the income directly into the fund, and then, of course, we have an asset under management charge and a percentage of profit, which is 1.75 and 15% respectively. So my goal ultimately is to create as much yield in that fund as possible. So to answer your question, if we have a loan in which I can price, so my target yield is going to be 14 to 15% gross, which is going to enable me to deliver to you, 10.5 to 12% net. Again, we've been averaging a little bit north of 11%. I'm looking at each one of those transactions and figuring out how that's going to affect our yield. So if we've got high quality transactions that I need to be competitive in the market, as I was mentioning before, we go out as light as 995 and 1.5 on a wholesale transaction. We're definitely going to sell that asset because it's not going to meet our yield requirements, and we sell those with no recourse, and they effectively act like leverage in our portfolio because we've taken the points into the yield and we're scraping a yield spread premium over time, but we've recouped our capital back. So that's primarily how I make my decision. We underwrite and fund every loan as if we're going to own it, so we don't differentiate our underwriting guidelines based upon whether we're going to sell or not. I think that's a dangerous practice. If you're a portfolio lender, you should underwrite every loan as if you're going to own it. But I will sell loans for the purpose of creating extra yield or liquidity, depending upon demand.
And the first question was pretty much already asked with the slide as far as percentage of loans in each state. But the second question, what percentage of your loans are in judicial states, and do you plan on reducing that percentage?
So Morgan, let me maybe
tell you the actual
one. Yeah.
Jeff can tell you the actual percentage, and I can give you the philosophy after that if you'd like.
Yeah. So the thing I would say is, yeah, we did an analysis, and currently we have 7.1% of our loan balance, if you will, in judicial foreclosure only states, and that really is 3 or 4 states and 5 to 7 loans out of, say, 50. So there's fairly small balance loans. One of the thoughts, and Morgan will elaborate, at least from a lending perspective and risk. Another question that we may talk about a little bit is taxation. And I can tell you, we're not necessarily incentivized to grow significant tax burdens in a variety of states. And so we'll probably tend to see that number, the judicial state only, stay a little bit smaller. And maybe even decrease at some point. And as you look around at a map of judicial and non-judicial states, out here in the West, and focus on Oregon, where over 75% of our portfolio is, and Washington's close to 10. We're close to 90% in just in our neck of the woods, and then a focus on Western states. And so we'll always have a handful of loans potentially considered in judicial states. They may be 50% LTV. They may be something that we just really feel is a strong yield and low risk for the fund. But in general, that number is very low to begin with, and probably for a variety of reasons will stay pretty low.
Yeah, I would agree. I would add this. In my opinion, the animosity or the fear surrounding judicial states it's valid, but it's also misunderstood at times. It's definitely more significant as it relates to an owner-occupied or a consumer transaction than a non-owner-occupied transaction. For instance, all consumer loan transactions, first mortgages for the most part, are non-recourse. All of our loans are recourse. We have the borrower sign a personal guarantee on every single transaction that we do, regardless if we're loaning to a corporation or LLC. And so, I would intend on foreclosing judicially most of the time in the event that we had a foreclosure situation, or at least I would want that tool available, because in a non-judicial foreclosure, you give up the right for your personal guarantee. So for me, it isn't as big of an impediment as it seems for others, based upon my understanding of it. I would probably focus more on what actual states you were dealing with, as opposed to judicial versus non-judicial. There's a reason that I don't loan in New York City. There's a reason I don't loan in New York State at all, and stay out of New Jersey, because those judicial states are in New York in particular, and some of the boroughs are some of the hardest states of all to foreclose in. Florida can also be difficult, but not nearly as difficult on a non-owner or a business purpose situation. But in summary, maybe because we're West Coast guys did perfect the trust deed, foreclosure, which I do agree with you is superior in almost all instances, unless you're trying to go after a personal guarantee. I don't see it as being a big issue for us moving forward, and I don't see an outsized amount of judicial loans coming in anytime soon.
All right. In the next question, in your recorded webinar, you talk about the 12-month drop in real estate values during the GFC. But in the case for for a foreclosure, wouldn't it be likely to take more than 12 months to perform the workout?
Yep. Hey, Morgan, let me at least I'll jump in, and then you can talk about, maybe the workout process. In the webinar, I think the point I was trying to get across to people is, if you look at the last recession and you look at the drop in real estate prices on SFR, single family homes, while there was a 40 to 50% drop over a period of 4 to 5 years, and the worst drop in value, at least nationally, it can vary by specific area, was around a 15% drop. And the point of that metric was to say, hey, we're starting on average with a 65% loan to value, so we got a 35% hedge against dropping real estate values, and we tend to generally do a 12-month interest-only loan that's got an average life of about 8 months. And so it was a way to kind of just, people have a lot of questions about risk and what sort of things keep you up at night that could cause the fund to lose principal. And so to try and put things in context, we're short-term lenders with a pretty significant hedge in terms of our loan to value. And we were just trying to show, what was the worst 12-month period? How much did collateral values drop? And we tend to have a lot of single-family home collateral, even though it's all commercially underwritten. And so that was the context of that point. Now, the question is really, okay, so you got a 12-month loan, and then it matures, and then you've got to foreclose, and then you got to work out. Yes, that's going to take a little bit longer of a time period. But once again, I think the point was trying to say, in general, we think we're going to have a chance to react fairly quickly, given the short-term lending nature and the LTV we maintain on our portfolio. And Morgan, maybe you have some more thoughts on it. Yeah.
Well, yeah, I would add more specifically, assuming the worst case scenario is you make a loan and it makes 12 payments and the guy doesn't, it matures, and so you start a foreclosure on month 12. You should be looking at a 17-month overall process in a non-judicial state, and probably is 20 up to 24 to 26 in a typical judicial state. There's obviously situations where that could be different, but points well taken. But I would say a vast majority of ours worst case scenario would be along the lines of 16 to 17 months.
All right. And
yep. The other point that, Mark, let me just jump in there too, is, I don't think we specifically stated it, but our fund does not use leverage in the sense of bank debt. And I think one of the key components of having any challenges in the fund that bust a covenant on a piece of debt that's in front of your investors, could trigger, the requirement to liquidate collateral, liquidate loans. And that's really what we saw take down a bunch of funds and a bunch of lenders is the triggering of an escalation in a loan covenant where it required liquidation and steep discounts and loss of principal. And so it's an opportunity at this, just to mention, we don't use leverage in the sense we don't have any debt in front of our investors, and there's not a situation we're required to liquidate in response to some changing economic environment. So we have the ability to tackle that foreclosure, take back a piece of real estate, liquidate it in the time frame that we think is right to get the most that we can for our borrowers or for our investors.
Very good. And can you add some color to what you mean when you say you've had zero defaults? Does that mean zero missed payments, et cetera?
No, specifically, we've had zero loans go through the foreclosure process in its entirety. We have 3 loans that are at as I mentioned earlier, at a notice of default stage. And we periodically have loans that bounce in between, 30 to 60 days late. It's quite common for this portfolio to have, 30s that bounce here and there, especially towards the end of the terms. Investors have a tendency to be slow when they know they're selling their property. But significant default for me would be categorized as over 60 days. And we don't have any over 60 days in the current portfolio outside of the 3 NODs that I mentioned.
And do you ever mark down the portfolio when things go into default or foreclosure to new investors?
Yes, and we can do. We also have the ability to do a kind of a loan loss reserve journal entry, in the books.
But you've never done that in the past? You have the ability, but you haven't done it yet?
I haven't done it yet because I've never had one. Like I said, these are the first 3 that we've actually gotten into this stage. I've done analysis on the collateral. I don't think there's a reason to write them down. Jeff and I will probably meet on it at our next meeting and talk about such.
All right.
But no, I haven't had the opportunity to do that. this
Yeah,
point?
I don't think, Mark, just in response to that, we absolutely, you know, if we felt that it was likely we'd get the collateral and we might take a loss, we would recognize that, you know, in a current period. But, you know, where we're underwritten in terms of the value of the collateral, we don't anticipate a loss. You know, coming out of the banking industry, you know, you can record reserves and you can anticipate that there'll be some unanticipated event, but that's not, you know, we do that kind of analysis when we look at these loans, you know, both at the get-go and then along the way, and we haven't concluded at some point that we need to take a loss. The other thing I would mention, Morgan, and you could, I don't know if you touched on it in the underwriting process, but, you know, you did touch on it briefly that late in the period of these loans, you know, occasionally see a late pay. And that's because in the underwriting process on the front end, I believe, you know, you generally underwrite with a 6-month liquidity requirement. And sometimes in the loans, it's actually built in the payments, if you will. And so I think that there's some upfront underwriting that's very beneficial in helping to avoid you know, late pay situations when you have these short-term lives.
Yeah, what I was trying to say is that these are business, you know, these are business professionals, these are investors. So like, it's not uncommon for them to not make their last mortgage payment if they're paying off. They'll just make a conscientious decision not to do that, because it's not a consumer situation. It's not that they put their properties at risk or such, but they've got so much equity, and so they might just rather pay a late fee than make their last payment. Not all of them, obviously. That just happens from time to time. So I mentioned it because like it can skew the default numbers sometimes, because you might have 2 or 3 guys that don't make their last mortgage payment because their property's in escrow and it's paying off next week. That's all.
All right. And how are you equipped to dispose of REO? Can you give examples for the categories bridge, new construction, and rehab?
Well, I have the pleasure of never having to have disposed any yet, but we're a full service, you know, we're a 50 state licensed mortgage servicer, debt collector, in our partnership with BSI, who's the same, very up to speed in terms of asset management and recovery. So we've got an asset management platform in 50 states. You know, excellent foreclosure processes, some of the best attorneys in the country to get those through. So again, we haven't had to test that on our own portfolio, but we've managed non-performing loan portfolios for dozens of other clients, many large institutional clients, and literally managed, you know, thousands of foreclosures and REO sales. So we feel very confident in our ability to do that, but we're happy that we haven't had to yet, at least for our own portfolio.
I just mentioned too, you know, we came through this last crisis, you know, in our respective financial institutions, and we did foreclose a ton of properties, took back a bunch of REOs, we took back half-finished condo projects, we took back land development halfway through, we took back spec building loans, and we got to figure out how to deal with that. We developed relationships with partners, whether they be builders or contractors, to either decide to liquidate something from the get-go, to work through to the next level, sell it to the right level of investors. So we've lived through this process in spades, you know, in 2007, moving forward for 3 or 4 years, and so we bring all that experience to this process. But as Morgan said, we haven't had to leverage any of that experience to date, which is a nice thing.
All right. And how much cash do you hold in reserve for upcoming construction rehab disbursements?
We hold 100% of the rehab renovation funds in a separate account. If you're to look at our balance sheet, you'd notice that the funds have segregated accounts. And so even though in our construction and our renovation loans, we operate or charge what's called Dutch interest, if you're familiar with that, meaning we charge interest on the full amount of the construction draw, irregardless of we've dispersed it, which just increases yields. It also affords us the ability to take those funds and segregate them and stick them aside because they're earning interest whether they're in the borrower's hands or not. So we do that as a way to, you know, keep our liquidity straight.
Just as a rough measure, at March 31st of 2019, just a few months ago, if you looked at our balance sheet, a little over 10% of total assets was in cash. Now,
But
be it earmarked most. Yeah. What's that?
But it's not really a cash drag on yield, since some of that, if not all of it's actually earning interest, but has not.
Oh yeah, the vast majority of it's earning. Yeah. Remember, Morgan said we tend to lend 3 to 4 times the balance that we have in our fund to put to work. So you can bet almost every last dollar's either spoken for or put to work in a loan. There's not a lot of idle money sitting around.
But we do have times when liquidity comes in. You know, I mean, like we get 3 or 4 big loans pay off, and we might be at 20% liquidity for a couple of weeks, and then we get it out. So it's a balancing act between selling assets and not selling assets and maintaining liquidity. But the liquidity that's required to keep the construction and renovation loans is not even part of that analysis. That's set aside because it's already earning.
But you could conceivably have more money loaned than on the balance sheet, since some of it's in reserves to go out later. And if you lend it all out, you could actually be at 105, 110%. Correct?
Make sure I understand your question. We could have more money. What?
I mean, you could lend more money than you have assets, since it's going out over time, but you're earning interest on like you loan $1 million to a guy, but only
that's right.
keep half of it behind, but loan that half means sitting there to another guy in anticipation of.
Yeah. I segregate it for that very reason, that I don't do that. But yes, and there's been times where, you know, if there's $3 million sitting in the reserve account that's designated for the next 12 months of construction, if we need to take 200 out of that on a short-term basis, I can do that. But I try to not, just in my cash management philosophy.
All right. And with interest rates trending lower, how much impact do you expect on your returns?
I don't really, to be honest with you. I don't find a real general correlation between market interest rates and the rates for this product. I find it more a correlation between competition and the patch of land and the things that you had mentioned earlier in the discussion.
I would just mention, it's another comment about leverage. You know, banks and the like, these larger institutions, their funding source comes from rate sensitive stuff, deposits, you know, loans. And when those adjust, they have to potentially, you know, yields can adjust on their loan balance. But, you know, our source of funds is you, the investor. And, you know, we're just trying to get you as high of interest rate as we can. And that's really doesn't dictate, you know, the amount that we can charge our borrower.
All right. And the next question is on your K1. So you issue just one federal K1 and one Oregon K1. Question kind of goes on for a while, but if maybe you can address that.
Yeah, so this is an interesting issue. I mean, and it really comes down to an analysis that we do a couple times a year. We look at our various state tax income. There is an argument where you can allocate a little income to various states where you have loan collateral. But as we do our analysis, almost 90% of our loan portfolio is in the Oregon, Washington area. Washington's a non-state income tax state. And so by the time you would allocate a nominal amount of income to another state, and then you spread it around among investors, you'd start to be issuing K1s for $50 and the like. And so there's some level where if we achieved a certain amount of volume by a state, we'd consider adding that state in as an additional K1. But at this point, it's been so de minimis. And that this is a common practice, I think, with a variety of funds and within the accounting and legal industry, in terms of there's got to be some sort of dollar significance to justify how you allocate. All that being said, as we grow and this becomes, there starts to become more and more taxable income by state, that's one of the items that might push a fund to become a REIT and switch from a K1 to a 1099 status, which kind of alleviates the issue of potentially needing to look at state taxable income. So hopefully that's a helpful answer.
Yep, it is. And how do you collateralize your bridge loans?
I'm sorry, could you say that one more time?
How do you collateralize your bridge loans?
They're 100% real
Same.
estate, first position only. They're, yeah.
All right.
All our loans are collateralized the same.
And I think you had kind of addressed some of this in the presentation, but can you talk about the LTC metric as opposed to LTV and how those differences can affect returns?
Sure. We use three primary metrics: as is loan to value. Well, let me back up for a second. In a bridge loan situation, we use loan to value. That's all we use because we're not anticipating or dealing with any renovation or any future value. So loan to value on a bridge loan is the current value is all we're using. Just what you guys are used to. When you get into a renovation or a construction loan, you're trying to figure out an as repaired or as completed value, and so loan to cost becomes important, as does we call it LTARV, loan to as repaired value. And so, loan to cost, basically if you take the purchase price plus the improvements and add those together, that's the total cost. And or in a construction loan, if you take the lot plus the improvements, add those together, that's the total cost. We're comfortable lending up to 80% of the total cost on an asset, assuming that loan does not exceed 65 to a max of 70% of the as completed value. And then lastly, coming back to our original variable, which is loan to value, as is loan to value also plays an importance, because at no time are we going to be lent out or dispersed on that loan, more than our as is loan to value of say 65%. So sounds confusing, but what I mean is that in the case of a renovation or a construction loan, while we may be at 80% loan to cost, we've got a certain amount of that money that's being withheld in an escrow account or a rehab holdback account. So at any given time, we always maintain our as is loan to value in the 65-ish% range, with our future repaired value being consistent with our underwriting guidelines. As that property is improved and it's inspected, and we can basically justify its increase in value based upon the appraisal that we've done and the analysis that we've done, then we will draw that money out, and with the intent of keeping our as is loan to value basically consistent through the entire duration of the loan. Is it perfect? No, it can ebb and flow a little bit based upon what types of improvements, but it's important to note that we govern that process and try to always maintain an as is LTV of 65% throughout it, but we use the other two parameters to set up the loan.
But you don't put much credence in the loan to after repair value. I mean, that number's pretty much a voodoo number.
We put a lot of credence into it. We will, on a typical construction loan, it would be like your maximum loan amount is going to be the minimum of 80% loan to cost, not to exceed, call it 65 or 70% of as repaired. It's just that 80% loan to cost is going to be made up of money that's not yet released. And it's sitting in a holdback account. And so that's why we use the as is LTV as the third parameter.
Right. Are there any plans to convert to a REIT structure anytime in the near future?
We've thought about that, and it might cross our radar maybe around the 50 million mark in terms of our fund size. It's a little bit more expensive of a structure. It would have a little bit of a drag on the yield for our investors. We like it for the tax issue. We have to have a conversation. We need feedback from investors for those that really focus on developing passive income, as a tax planning strategy. But we see that as an easier structure the larger we get, and so we just have to feel through the time frame and with our investor feedback, find out when that may be.
And with only a 6-month lockup period and likelihood of near-term recession, how would a large capital return request by a significant number of investors affect fund performance?
I don't know if those are correlated necessarily, but the redemption would be made as capital is available. As Jeff's mentioned, we've never been able to not meet a redemption request in 5 to 7 days. At the same time, we've never had a massive request. So, but as capital is taken out of the fund, there's the return obviously is based upon income divided by total capital. So if the denominator decreases, it doesn't necessarily mean that the yield is going to decrease. So I'm not finding a necessarily a relationship there, but we would return capital as quickly as possible in the event that we had that type of situation, and that would come organically through just the loans retiring and paying off. We're having loans pay off every week here just because of the short-term nature, and then if we needed to, we could go out and sell assets and create additional liquidity. So I believe that in the event that there was a mass call for capital, we could have an orderly and profitable wind down.
All right. And what are the typical loan prepayment fees?
We don't charge prepayment penalties on any of our loans.
So they can pay back anytime. You don't.
They can. I've always been of the belief that hard money lenders should take money back whenever somebody wants to give it to them. So, in fact, the faster they pay off, the better, typically, because most of our alpha is made in the points. Yep. So I'd love to make loans and charge 2 points and have them pay off every month.
And you talk about the bridge loans. Can you give us some examples of what the assets the bridge loans are on and how that works?
And Morgan, real quickly,
Sure.
I think that there's, people tend to, when they hear the word bridge, they tend to think of working capital and the like. So as you respond, I think that's the nature of why someone's asking this question is they see bridge lending and they think working capital loans. Yeah.
It's simply a private loan made on an asset that we're not participating in any renovation or construction. So a typical situation is a borrower, an investor has the opportunity to close on something quickly, let's say an asset, maybe they're getting a good deal on it, and they don't have the time it takes to go out and get a traditional loan. So that might be because it's in a distressed situation, it's a foreclosure, it's something, or they need to close in 7 to 15 days, and the traditional loan process would take 35 to 40. So they'll come to us, put a significant down payment down. They're all first position private money mortgages, just like all our other loans. They just don't have a construction or a rehab component to them. Or another typical situation is an investor will need cash for a certain reason, usually to go purchase something else or do something, and so maybe they have a asset that they own free and clear, and they need to use that asset as a tool to leverage some capital to do something else. We do it in that situation. But
what are the typical terms of those bridge loans? Length and
they're very similar to our other loans, but double digit, 12 and 2 would be a typical bridge loan, 12% and a couple points.
But if they're bridging just to wait for the refinance, you would think that would only take 2 or 3 months, or to get a financing on it at all. I mean, are there a lot of them just 2 or 3 months?
I would say the average bridge loan is probably like 3 to 4 months. Yeah.
Yep.
They definitely have a shorter duration. That's why they're typically more profitable for us. They're also usually like time sensitive, so it's less. There's less shoppers, to be honest. A bridge loan typically makes sense, and it's because the investor has the option, the opportunity to either buy something right, or he's going to make a ton of dough, so he doesn't really care if he pays 12% and 2 points, or he's got the ability to act on something that he needs his capital. So it's just there makes sense business situation loans, typically based on opportunity.
And your sample K1 shows all your income on line 1. Will you continue to report that going forward, i.e. on line 1?
I think so. I'd have to do a little homework and research in terms of where it may show up elsewhere, but my general answer would be
under interest income, which is line, I don't know, 3 maybe. I don't know.
Yeah, well, it's partnership. I mean, you really are you're an investor in a LLC,
Yep.
right? You're a member in an LLC, so it's really like you own a mortgage company.
Yep.
You're a passive owner in a mortgage company.
And do you do any business loans that may be secured by real estate? Or are they all straight up fix and flips or bridge loans?
Well, we call every one of these loans a business purpose loan because we want to differentiate them from being consumer loans. They're loans made for people for their personal residences. I think the question that they may have been asking is we do not do loans that are not secured by real estate. So we don't do unsecured business loans. But, you know,
But
a
if I have a
loan to a
manufacturing
business.
company and I own the building, but I'm having cash flow issues, would you loan me
Oh,
$500 million to keep my business afloat and
good
collateral?
question. Potentially, you know, caveat being we'd have to underwrite the collateral and the cash flows and all the other things associated with it. Haven't really had that opportunity very often, to be honest.
So,
But we consider them on a case by case basis.
but you haven't. There's none of that.
Again, it's really going to come. It's really going to come down to the collateral. You know, I can't think of any examples of loans that we've done like that in the past. Or that are in the fund currently.
I guess the last question I see is diversification. Do you have a metric on how you want to diversify versus asset class, geography? Are there any parameters that for diversification within the fund?
You know, I'm more concentrated on booking good loans, regardless of where they're at. There are definitely areas, as I've kind of mentioned before, that I want to diversify out of. So I'm not a big fan of the Northeast for several reasons. I don't understand it very well. I don't have boots on the ground. I don't like loans in New York. I don't trust loans in New Jersey. And I'm leery of loans in Chicago. That's just kind of my overall underwriting sense, which doesn't mean that there's anything in that other than just my personal opinions.
What about California?
But
what do you think about lending in California?
We loan in California. We loan in California periodically, but I'll be honest, it's so competitive that we typically have a difficult time obtaining the yields in California that we would like to get. So we do occasionally do it when we got an investor or a partner down there that it works for. But there's so much private capital available in California today that you know, we would be needing to accept yields of probably 300 to 400 basis points lower than what we're targeting in our other regions. But we do have loans on the books today in California, or at least we have loans that we've sold that are in California. So.
All right. Well, that seems to be the end of the questions, and it's been about an hour anyway. But can you just kind of briefly go over the steps to invest, when they need to invest, when you close, et cetera, who to contact?
Yeah, so we've made the process pretty simple. You know, our PPM has in the exhibits both our admission agreement and the operating agreement for the LLC. And we've taken that and we've created a one-page form where we ask for some information. So we need a tax ID from an individual or a company so we can file the correct K-1. We need a address so we can mail you your quarterly statement, newsletter. We send out balance sheet and income statement every quarter for the fund. We send out a calculation of our fees. You know, as Morgan said, we'd like to be very transparent as to what's going on with every dollar in this fund. It has a spot for a signature, which you're basically executing the admission agreement and the operating agreement. And then I countersign, or Morgan can countersign that. And so we really only need that document to admit you into the fund. And then some typical things you might provide if you decide you're also on that form, you elect whether you want to reinvest or whether you want quarterly dividends paid out. And if you'd like a payout of dividends, then we have a separate ACH form so we can take your bank account information and do an auto deposit to your bank account. We offer, you know, we do need some sort of accreditation validation from a third party. We have a template letter that you could take to your provider if you need that. If you happen to have something, that's great. If you want to work with me personally, I'm happy to validate accreditation, you know, through some financial information if that's how it needs to work for you. So it's pretty straightforward with just a couple of forms. We take money in and we put it to work on the first of the month following when we receive it. So any money that we receive between now and July 1st will start getting credited for our investor on July 1st. If we're working with you and we're working through a process, and you know, we might give you a little flexibility if you go a few days over that, but you know, those cases are kind of reserved for folks that are actively working on trying to get their funds to us and we're stumbling through something. We're set up to take IRA money, so we're probably on 12 to 15 custodial platforms. If you need us to get on a platform, happy to provide our information. These guys can take anywhere from a couple days to a couple weeks based on their approval process. You know, it's a rubber stamp. It's just how long that and how quickly they're able to work. And of course, as an IRA custodian, will need to sign off on behalf of your account to send funds our way. So we provide that on the form, the signature form, or in the case that they want the official admission agreement and operating agreement, we can execute those with them. So it's pretty straightforward.
Sounds good. Well, I do see that you are on Fidelity's, and we got a QSIP number for that, so that will make it easier for a lot of people. But thank you so much for your time. Anything else you'd like to add in closing?
Well, just you know, appreciate everybody's time. You know, I would mention for those that may have some interest at some level in the Sortis family of funds, we also run some opportunity zone funds, and so those funds are designed for folks with capital gains. We're working on putting together another conservative fund, and we most likely will have a couple of other funds in the future to take advantage of some of the deal flow and the activity we see. Yeah, I think for now the focus is on the Sortis Income Fund as a result of this webinar, and hopefully we've been able to provide everybody a lot of good information.
Very good. I agree. And
yeah,
go ahead. I'm sorry.
I'll just add thanks. Yeah, just really quickly, thanks for the opportunity. Appreciate the chance to talk with everyone. And I'll just reiterate that if anyone has any direct questions about underwriting deals, how stuff works, feel free to contact me directly. I'd be happy to answer any questions you may have about the process or any of the loans. But again, thank you for the time.
You're very welcome. Everybody have a good day.
Thank you.
Thank you. All right. Anybody want to make any comments, questions? I think they're both gone. They are. Let me unmute everybody. And no big surprises for me. Guess the good news is I've had no foreclosures. The number of the ones that are in a little bit of trouble, it's pretty insignificant. 400,000 out of 25 million. And track record's good. That's the key to me, for me. Anybody else have any comments?
They're new and small, and some people don't like the 70% LTV. Any other negatives? I was positive.
Yeah, I mean, I guess their experience is, you know, the biggest thing. But I think they've personally been in the mortgage business for quite some time, but the fund is relatively new, that's for sure.
Yeah. Any other negatives from the one?
And nothing jumped out at me.
Okay.
All right, anybody else?
It's a place for Broadmark money.
Well, apparently there's a lot coming out.
Apparently.
Like mass exodus. I think you may get out now instead of later.
Any other similar selections to replace Broadmark that people are already in?
Yeah, there's 2 or 3. They're on the forum. Anybody else remember the other names?
I was thinking it's sorry, Wood. There's this Sortis. There's 2 or 3 good candidates.
There's 2 or 3 candidates under the debt parse. You can look on the forum. They're I'm not a big debt guy, so I'm not in many of them, but they're definitely out there.
One of them was Sundance Debt, right? I think
Yep, Sundance.
Yeah, that's right.
Correct. All right. Well, I'm on vacation, so I'm going to call it a day unless somebody else has another question or comment.
Hey, did they say, will they take solo for 401k? I heard him say IRA, but does that include solo 401k as well?
He said that they do.
I mean, usually if it's IRA, we'll take 401k. 401k is usually a little easier since it's self-directed.
Oh, okay.
But as always, I think actually one sponsor took one over the other, and I never did understand why. But
I've run into a couple sponsors that will take IRA and not 401k.
Yep. All right. Well, have a good afternoon, everybody.
Hey, Mark.
Oh, yes.
One more question. So what space are you looking at right now? You will put your money
new
to work.
dollars. Yep.
Yes.
I mean, I'm mostly equity, but it's a matter of finding a unique opportunity. I mean, I did some of the alternative stuff. I'm in Loyola, which I kind of regret because it's sucking wind.
That's for sure.
But the legal fund and
Like the litigation finance.
litigation finance fund I'm in. I actually need to write up my stuff I've done the last year, but it's the funds, the MLGs, the grub, anything I can get in late. I came in late on the 10 federal. I'll probably wait to the very end on the next 10 federal. I mean, I'm just trying to find some kind of advantage, and usually it's the funds that let you go in at the last minute. I haven't. 2-3 years ago, I was doing 10 or 20 investments a year. Now I'm doing maybe 5 or 6. So I am investing more money in less deals and trying to be more selective. Is pretty much what I'm doing right now.
Yeah, I just sent my money out to a Reliance self-storage fund. You in that too, right?
Yeah, I haven't pulled the trigger on it, but I'm thinking now I'll probably wait till almost before it closes as well. There is an advantage to going in late, so if I can see that advantage, I will, unless something crazy happens between now and whenever it closes. But I think it's got another 6 months is what they're guessing.
Oh, I thought the money needs to be in by like June 24.
Well, they're pushing because they've got a whole bunch of assets lined up to sell. I mean, to buy, and so they definitely want you to close down. But you don't have to do what they want necessarily. You can do with your best interest.
Oh, okay.
Yeah, I mean,
okay. So you're thinking about the federal? I know. Yeah, I'm thinking about the MLG too.
Yep, and MLG, their people are in it now, but I've waited to the bitter end on all 3 funds, and it's worked out well. But it's worked out for people investing early.
Oh, do you know when MLG will be closing? I'm looking at the 1099 dividends instead of the MLG.
It just opened. I would think at least another year.
Another year. Okay.
I mean, the last one was open for almost 2 years. So, I mean, I'm pretty sure each fund is bigger than one before. I haven't even looked at fund 4.
They can go up to 250, and I think they have reached maybe around 28 or 40 million. So it's a long. There should be enough or a long time basically remaining.
Yeah, I would think at least a year, and you'll see it on the forum as they get closer because the forum gets very busy. That thread will get very busy as it gets close to its end of its life.
So the MLG would be like more towards the end of the year, you would think?
If not summer of next year. I mean, that one just opened 2-3 months ago. I mean, I think Fund 3 we closed in December, January maybe. And
Fund 3 closed September 30th.
September 30th. Yep. So there's time.
Oh, okay. So you give us a heads up when you're sending the money.
Yeah.
we the newbies like sending the money first, so we're gonna miss the deal.
Yeah, I mean that's on CrowdStreet. They've had a few of those deals that have filled up in 2 or 3 hours, but I need more time to do due diligence and jump on those. So I'll miss all those boats personally.
Oh, so which one are you doing due diligence right now? You want to share?
I'm trying to think. I sent money in. I'll have to get back to you. I'm literally at the beach and I don't have anything in front of me. And but I did just send money in last week on something, but I couldn't tell you the top of my head what it is.
I try to copy you.
Yeah, well, I mean, I used to put it on the spreadsheet where I'm investing, so you'll see on the express interest, but investments by member.
Express doesn't mean you're gonna send in the money though, right?
Oh, when I've actually sent the money in, true, because we did have it color coordinated.
Actually, you send the money.
Yeah.
Can I send you an email?
Sure.
I mean, like next week.
Yeah, send me an email so I remember, and I'll show you what I've done lately.
Yeah, I want to like copy you a little bit. You know more.
Well, not any, but there's a lot of people out there who know what they're doing. So I try not to be the guru. I don't want to be that guy. So, but I'll share what I'll do.
Than me, so not guru, but you know more. So I am going to be going down to the conference. I will can't wait to meet you.
Very good.
I will send you an email. Yep. And then talk to you next week. Enjoy your vacation, Mark.
All right, very good. Everybody have a good day.
Bye-bye.